Imagine this. You manage millions of dollars. Investors trust you with their savings. Financial experts admire your intelligence. Everything seems to be going perfectly. Then, almost overnight, the world changes. The stock market crashes. Prices collapse. Fear spreads everywhere. Investors panic. The phone never stops ringing. And year after year, the losses continue. By the time the nightmare is over, nearly 70% of your wealth has disappeared. Most people would never recover from something like this. Most would walk away, defeated. But one man didn't. Instead of giving up, he used the experience to develop a set of principles that would change the world of investing forever. His name was Benjamin Graham. You may not know his name, but you've almost certainly heard of his most famous student, Warren Buffett. In fact, Buffett once said that most of his investment philosophy came directly from Graham's teachings. What's remarkable is that Graham's ideas were never meant only for the rich. They were designed for anyone who wanted to make smarter financial decisions. And his story begins long before Wall Street. Benjamin Graham was born in 1894. His family moved to the United States hoping for a better future. But life quickly became difficult. His father died when Benjamin was still young. His mother struggled to support the family and eventually lost much of their money through unsuccessful investments. As a child, Graham learned something many people never truly understand. Money can disappear far more quickly than it is earned. Despite these hardships, he excelled in school and graduated near the top of his class at Columbia University. His intelligence opened doors, and before long he found himself on Wall Street. There, his talent for analyzing businesses helped him rise rapidly through the financial world. By the late 1920s, he was managing large amounts of money and was considered one of the brightest investment minds of his generation. Then came 1929. One of the most devastating stock market crashes in history. The Great Depression followed, destroying fortunes across America. Graham's investment partnership was hit hard. Its value fell by roughly 70%. Imagine the pressure. Clients were losing money. Confidence was disappearing. Everything he had worked for seemed to be collapsing around him. But instead of blaming bad luck, Graham asked himself a difficult question. What mistakes did I make? That question changed everything. After years of reflection and analysis, he realized that even great companies can be terrible investments if you pay too much for them. He understood that investors often become trapped by optimism. They assume prices will keep rising simply because they have risen in the past. Graham decided there had to be a safer way. A smarter way. That idea eventually became known as the margin of safety. The concept was simple. Never pay full price when uncertainty exists. Always leave room for mistakes. Always protect yourself against the unexpected. For example, if a company owned assets worth $100 but the market valued the entire business at only $60, Graham saw an opportunity. Instead of following emotions, headlines, or market trends, he focused on numbers. Facts. Value. Discipline. Over time, this approach transformed his results. His investment partnership gradually recovered and went on to achieve impressive long-term performance. Between 1936 and 1956, Graham generated average annual returns of approximately 17%. Not for a year. Not for a lucky streak. For 2 decades. While others chased excitement, Graham focused on patience. While others followed the crowd, he followed principles. Then, in 1949, he published a book that would influence generations of investors. The Intelligent Investor. More than 70 years later, it is still considered one of the greatest books ever written on investing. Its ideas shaped the thinking of countless successful investors, including Warren Buffett. Yet perhaps the most surprising part of Graham's story is how he lived. Despite achieving financial success, he never became obsessed with luxury. He didn't try to impress people. He didn't build his identity around wealth. He preferred teaching, writing, studying, and sharing knowledge. For Graham, money was not a way to show power. It was a tool that provided freedom, security, and independence. And that may be his most valuable lesson. Because Graham understood something that many investors still forget today. The market is driven by emotions. Fear. Greed. Excitement. Panic. But successful investing requires something different. It requires patience. Discipline. Rational thinking. When everyone becomes greedy, be cautious. When everyone becomes fearful, look for opportunities. Benjamin Graham proved that failure does not have to be final. A devastating loss does not have to define your future. The same crash that destroys one person can become the turning point that transforms another. His legacy was never simply about making money. It was about learning how to think clearly when everyone else is losing control. And perhaps that is why, decades after his death, Benjamin Graham continues to teach investors around the world. Not through predictions. Not through promises. But through timeless principles that still work today.